Hello and welcome to Nest Egg Guru. Today we are going to be shedding new light on retirement spending strategies. Specifically, we will be discussing why basing one's initial portfolio spending amount off of a calculated safe withdrawal rate may not be an efficient planning paradigm, and why it is important to incorporate remaining balance considerations into the decision-making process. To get started with today's tutorial, let's run Nest Egg Guru's retirement spending calculator with a scenario that approximates a maximum safe withdrawal rate over a 30-year retirement time horizon. As you can see, I have pre-populated Nest Egg Guru to illustrate an initial retirement nest egg of $1 million with a $35,000 initial withdrawal amount that is adjusted at 3% per year for inflation. Although Nest Egg Guru permits users to account for future anticipated increases or decreases in portfolio withdrawals, in this analysis, we will assume no further withdrawal changes beyond inflation adjustments. We will assume a classic allocation at retirement of 60% stocks, 30% bonds, and 10% cash. For the stock portion, we will keep the default allocation for large cap, small cap, and foreign equities. At this point, it is important to point out that Nest Egg Guru is one of the only apps that allows users to account for the current historic low interest rate environment. For bonds, we are going to assume a 3% annual fixed rate of return similar to what could be obtained today from intermediate term corporate bonds or CDs. For cash, we will assume a 0% yield. Since it is important to account for internal and external investment expenses, in this illustration we will assume total expenses of 1% per year. For our final input, we will choose our withdrawal strategy. While most retirement planning apps automatically assume proportional withdrawals from each asset class with annual rebalancing, recent research suggests that this is not an optimal way to spend down a portfolio. Since Nest Egg Guru permits users to test alternative strategies, in this example, we will assume that the retiree spends down the cash and bond portion of the portfolio first. With our basic inputs complete, let's hit the Submit button and generate our simulations. As you can see, this 3.5% inflation-adjusted withdrawal rate was sustainable over the 30-year time period in all but the worst simulations. In fact, if we scroll down to the results of the remaining balance table, we also find that in more than 90% of the simulations, not only was the initial nest egg not depleted, but the remaining balance at the end of the 30 years was still greater than the initial $1 million nest egg value. If that seems like a lot of chips that may be left on the table, you might be right. Now let's see what happens if we hold all of our other inputs constant, but we increase our initial withdrawal amount from $35,000 to $45,000. This change represents almost 30% more income at retirement. As you can see, the $10,000 increase in the initial withdrawal amount leads to a higher number of simulations failing within the 30-year period. Specifically, in 8% of the simulations, the nest egg was depleted in less than 30 years. However, when we scroll down to the remaining balance data, we see that more than 95% of the simulations still produced a remaining balance at the end of the 25 years. So what should we make of these two illustrations? First, it is important to understand that the bottom 10% of the simulations are intended to illustrate how the nest egg might hold up under unusually adverse investment conditions. The worst of the simulation results are likely as bad or worse than any 30-year period in the historical record. Second, to put this in a real-world context, let's assume that the calculator user is age 65 at retirement. A 30-year time horizon would take the retiree to age 95. With this perspective, the value of including the remaining balance data is that it enables the calculator user in this example to decide if the value of having 30% more initial retirement income is worth the possibility under extreme adverse market conditions of facing the possibility of running out of money at age 90. We would encourage you to let this concept sink in a little bit. While nearly all other retirement planning apps simply produce a sustainable withdrawal rate or probability of sustainability, by incorporating and displaying the remaining balance data from the simulations, Nest Egg Guru may enable retirees to quantify the trade-off between depletion risk and standard of living today. It also helps give a general sense of the size of one's nest egg that may be left for one's heirs. Thank you for tuning in to Nest Egg Guru.